Hey guys, and welcome to another week of State of the Market. As you all know, I am Marc Fattore, joined by my lovely co-host Jennifer Dolh. And again, this week we jump into a whole array of things that have been asked by you guys in the market. So Jen, I will let you take it away.
Thank you. Okay, so first question, as always, I have 3 questions today.
Yep.
When building out an investment plan for your clients, do you factor in inflation rates? And if so, what are your rates currently sitting at right now, anticipating a 10-year growth?
As always, guys, you're sending in fantastic questions, and this is another really good one. Of course, we will always factor in inflation into our feasibilities and models that we do for our clients when it comes to looking at investments. Now, what we're running at the moment is sitting between 4.5% to 5%. That's how we do it at the moment. If anything, sometimes we like to push it up even higher. But look, obviously, we understand RBA is trying to reduce that down to that 2 to 3 mark. Whether that gets there anytime soon is a different story, of course. But more importantly, yes, we will always factor in inflation, not only from a loss perspective, but also from a gaining perspective. So we treat our investments like they are they are a job, right? They are a working asset for us. So what they are going to do is obviously work for us. Now we need to be staying above that inflation rate all the time. So it is super important to definitely factor that in. Yeah.
Great. It's good to know, actually. Well, we know that inflation's on a peak at the moment.
Yep.
Second question, in a cooling real estate market, is this the time to look for assets in a regional location as opposed to metro capital cities from a long-term perspective?
Something I've been asked quite a lot actually at the moment, and it's something that I believe that yes, we should definitely understand them a bit more. Would I personally invest into them? Probably not. I understand, yes, we are getting the yield, but as a smart investor, you should be able to maximize the yield within your metropolitan capital city investment, of course. Understanding that, we know that sometimes it's not always the case, depending on what time you bought in the market, so on and so forth. But of course, it is super important to factor in what it is we're going to obviously lose out on if we look for just one thing, like yield, for example. So it is definitely something we factor in. It is something that I certainly recommend looking further into. But is it something I do? No, it's not.
We have seen in the past there are better rental yields to be taking advantage of, I guess. What are your thoughts on that?
Again, I think it also depends on what stage you are in your journey. So if you're 55 years of age, for example, then absolutely I would be looking at cash on cash return a lot sooner, a lot quicker. If you're 35, 25 years of age, I would be looking at that long-term growth. Yes, we want to replace our income at some stage, but the reality is we know that we've got a lot of time left in the market as an employee or a business owner or whatever it may be. So from a cash flow perspective, you're probably going to get the best returns with your job or your business, whereas your assets will give you that long-term growth that is required. So all dependent, yeah.
Great. And finally, we have seen incredible valuations in the past in real estate and tech sectors. How do you see these faring out over the next 2 to 4 years?
Yeah, something I've spoken about quite a lot actually. You've probably heard me talk about it to a lot of our clients. So this is an interesting one where the last 2 years, especially since the start of the pandemic with COVID-19, back in, let's call it March 2020, from that period, especially leading into 21 and even towards the back end of 21, we saw some incredible valuations. And I talk about this a lot to a lot of our clients who are in the tech space, where there were numbers that we had never seen before from a valuation standpoint. But the key issue here was these organizations were trading at a loss. And that was a big factor. So looking at that now, whether we look at equity markets, whether we look at debt markets, things like that, what we can probably all agree on is that the valuations are certainly going to cool down a little bit. Real estate, tech, any other industry you can think of, right? But everything is going to come down now to having turnover now, having cash flow. It's going to be super important as we move into constrained markets, at least for the next 2 to 4 years. So I certainly think we are going to see some wriggle room when it comes to valuations, but from a cash flow perspective, I think we're certainly going to see people think twice before investing into these type of organizations.
I agree totally. That's all for today, actually.
Awesome.
If you guys keep on sending us directly your questions or any recommendations on what you want us to cover next, please feel free to do so or comment that below. Other than that, it's been your Tuesday State of the Market, and we'll see you guys next week. Enjoy.
See you guys.